Welcome to Kitco News. I'm Niels Christensen. Investors have an insatiable appetite for gold-backed exchange-traded products. We've seen record inflows so far this year, but is this sustainable? Here to talk about his expectations for the rest of the year is Will Rhind, CEO of GraniteShares. Will, thank you very much for joining us today. It's always a pleasure to have you on.
Always a pleasure to talk to you, Niels. Thank you for having me on.
So one of the reasons why we're talking is because in late June, GraniteShares, your bar gold ETF, hit over $1 billion in AUM. And I'm just, the question I have is, does this momentum last? What are your thoughts?
Yeah, well, I think the momentum here is going to last as long as people think that, gold still has some room to go up. And, put simply, what's kind of interesting about all of this gold flows is the highest amount of flows or assets we've seen in the gold market, since the peak in 2011. So two things have happened. Now we're over $100 billion in terms of assets in gold ETFs in America. Mm-hmm. So that's the highest level that we've been at since the market peaked. And then obviously in terms of price, we're at the highest level since the market peaked in 2011. So, where we are right now, I think we're set up. And I think the good thing about these inventories is they've been building pretty steadily since gold bottomed at around that sort of 2015, 2016 area. So I think as long as people think that the price has further room to grow, we'll continue to see assets coming into the gold market.
Well, then, that leads into the next question. Do you think the price has further room to grow? We've pushed above $1,800 an ounce. We've hit the highest levels since 2011. A lot of people are calling for gold prices to hit all-time highs. Do you think we get there?
I think we do. And here's sort of my take on it is that, remember back in 2008, remember that regardless of when you bought gold in that year, whether you bought it at the intra, the high for that year or the low, you were handsomely rewarded for buying gold in the years afterwards. But it didn't take, it took 3 years for gold to peak after the 2008 financial crisis, obviously peaking in 2011. And we had some of the same conditions that we've got today in terms of, the catalysts that were alive and propelled gold to that level. So, monetary stimulus, money printing, put more simply, interest rates lowering or interest rates kind of going to zero, and a fear of, currency debasement, namely obviously the US dollar. And this is exactly what's happening again, albeit just on an amplified level. And here's the really interesting thing. It's happened so much quicker. So remember, the financial crisis, happened in 2008, September 2008. And it didn't take, it took another few years for gold to peak. But now, what we're talking about in terms of the major catalysts only happened in March. That's only a few months ago. And already we've got gold prices at 18. So I think that, in terms of where we are today, we certainly have more room to go because I think this crisis has more room to go. There's going to be more stimulus and, certainly interest rates, it's difficult to see where interest rates go from here, but the market was anticipating, the probability of negative interest rates the first time. And so all of that, I think, is a positive environment for gold.
And I guess one of the things from the 2011 peak is that we didn't really know how long interest rates were going to remain low. We didn't really know. It was unprecedented, so we didn't know what to expect. It took 10 years for the Fed to try to start to normalize interest rates. They sort of gave up last year. Does that mean we should expect, no matter what we forecast, that we should expect interest rates to be lower for much longer? We see the Fed, sort of broadcasting that they want to leave rates where they are until, for the next at least 2 years. Do you think it's going to take longer?
I think it's going to take longer, Niels. And also remember that, with the financial crisis in 2008, it was a financial crisis. So that was primarily limited or centered around the banking system. And one of the things that happened afterwards was that although there was stimulus, there was money printing, that was largely kept confined within the banking system, wasn't put out into the broader economy. And this time around, it's the broader economy that's been hit. And although there's money certainly going into the banks, this time the banks have got all the incentive in the world to lend that money and to get that money into the economy. And obviously, the government's not just relying on banks to do that. They're giving people money directly, giving money to industries directly where needed. But the point is, I think that there was an environment of austerity, one could say, after 2008 that limited, some of the effects, the inflationary effects that people, had predicted in terms of the money printing. This time around, I don't think those austerity measures are there. And frankly, I think that if anything, both political parties, everybody is incented to get this economy back up and running as quickly as possible. And that means putting as much liquidity into the market as possible. The casualty of that, one has to think, is going to be the dollar. And therefore, that's why people are flocking to gold.
Okay, and not only are people flocking to gold, but they actually also have more choice. Bar, for example, one of the lowest management fees in the industry. How has this changed the market? Like now it feels like investors can hold gold a lot longer without having to worry about management fees eating into their position.
Yeah, that's right. I mean, I think, remember one of the reasons why I founded GraniteShares in the first place and why we incepted or launched Bar as our sort of flagship gold ETF was I felt that the market was overpriced in terms of people were paying too much to own gold in a portfolio. And we wanted to do something about that. So offering Bar and offering the investor the ability to own gold in a very cost efficient manner is something that we've been able to do and have changed the industry accordingly. And so now, because obviously gold is a zero interest bearing asset, it behooves you to own it at the lowest cost possible in your portfolio to try and minimize the effects of obviously paying any kind of management fee. So certainly owning it in a low cost vehicle makes a big difference. And I think for people that are now looking upon this as a longer term event, and certainly more longer term reasons to own gold, is something that has to be very attractive to people.
The question I want to ask is a parabolic move. Like so far, we've seen a nice steady rise that feels sustainable. Like we didn't blow through 1800. And I'm sort of wondering, is that what gets you worried about the gold market? Are you worried that we're going to see something parabolic that we saw in 2011 that was clearly unsustainable?
I'm less worried about that right now. Like any bull market, there's almost inevitably going to be some kind of phase of euphoria. I just don't think that's right now. I don't think we're anywhere near that phase. I'll tell you why. We haven't seen, at least I haven't seen in our business, the tourists really come into the gold market in the same way that they came in 2011. So what I'm seeing, and from our business, we're seeing people that were allocated to gold maybe had taken that allocation down from 5% down to 1%. Maybe they got out of gold altogether. But those people have come back in. So people have bought gold before, have come back in, and are increasing allocations. What I haven't seen is really the tourists trade that haven't bought gold before, never owned gold before, and are now saying to me, "Hey, we've never bought gold before, but now we're desperate to buy. And how do we get in?" I haven't seen any of those people yet, and that's a good sign.
I like how you describe them as tourists. What gets them in? Is there a price level? Is like what's, because gold has attracted a lot of attention this year, and I'm sort of wondering, if the tourist isn't interested now, what gets him interested?
The tourist, for the most part, is a classic momentum investor. And so, to your point, in terms of the parabolic move, the tourist is just going to be looking at the charts, going to be looking at the momentum, and just going to be in any kind of trade when they see that momentum. You've seen it with the tech stocks, clearly been in a great momentum sort of move, and those stocks for a number of years. And I think Bank of America came out just saying that that's probably the most overcrowded trade out there. But certainly in something like gold, you've got to wait until it gets a lot more severe in terms of the move from here.
Okay, so this is a question that I've asked a bunch of fund managers. I want to put it to you as well. That everybody sort of says that the sweet spot to own gold is have a 5 to 10% position in your portfolio. But I'm sort of wondering, does that make sense in this environment? Should you be more maybe overweight? Is 10% enough? Is it too much? What are your thoughts in this environment?
Yeah, so that's a great question. I mean, I guess it's in many ways always defined by the strategy that you have. One thing I would say is let's start from the basics. First of all, in my opinion, you should own enough gold to be relevant. What does that mean? It means that from a mathematical perspective, it needs to do something to your portfolio. If you own 1% of your portfolio in gold, probably never going to do anything for you mathematically or for your portfolio. So, what's really the point? So start by owning a number which is significant. We've done a bunch of different modeling on this, and we've run scenarios of all sorts of different portfolios with various different allocations to gold. And actually, for last year, for 2019, which was a great year for equities and a great year for bonds, would you believe that the optimal allocation to gold was actually 35% in a 60-40 portfolio? So 60% bonds, 60% equities, 40% bonds. And obviously the proxy for that would be major, US bond market index and US equity market index. But actually replacing the majority of the bond portfolio with 35% gold, 60% equities, that was actually the perfect mix from a Sharpe ratio perspective. And Sharpe means that was the highest amount of return per unit of risk. And that was really interesting. So from my perspective, it wasn't an indicator that people should rush out and put 35% of the portfolio in gold. But just from a mathematical perspective, this particular time now with interest rates coming down to zero, I think what it says is there's a bigger case to add gold as part of your traditional fixed income allocation than ever before.
Have you updated those numbers? Like I'm sort of wondering. I mean, if it was in 2019 when interest rates, were above 1%, and do you think that number has changed with the Fed holding, sort of that zero bound range?
Yeah, it has, Niels, and that's something. I mean, for anybody who's interested, please contact us directly. We'll be happy to share that sort of research and that thinking. But yeah, I mean, it's only gotten better for gold, and indeed the allocation's only gotten higher. But it's just fascinating. I think. But the point of the story was that while 35% was the optimum for this particular study, what it showed you was that any addition of gold benefited the portfolio from a Sharpe ratio perspective. So even as low an allocation as 2.5% gold, all the way up to 40% gold, that it benefited you from a risk return perspective. And I think that's a really important takeaway for people, because a lot of people can't really contextualize, what amount of gold is in the portfolio. But I think from what this study particularly said was any amount of gold will help. And if anything, the more gold that you have, the more that it will help.
But obviously, from your research, it's bond yields that have the biggest impact on gold prices right now. So what are your thoughts on the Fed introducing some sort of yield curve control? Speculation growing that maybe they announce something as early as September.
Well, yeah, I mean, I think that's something that, I think they've hinted at doing. And, it's something that in some respects is kind of logical given the influence that they have now in terms of the bond market and the market more broadly. And look, their interest is clearly to hold rates low, while there's other, so much monetary stimulus, going on. And so what they don't want is to lose control of interest rates and have a higher interest rate environment. And I think, although they've said kind of publicly, at least Jerome Powell said publicly, they didn't think that negative interest rates were a good idea. The market in terms of the Fed fund futures, has been pricing in at least some probability of negative interest rates in the US before the end of the year. And so I think it's something that as we go further into this, if the economy doesn't, climb out of this relatively quickly, it's something that we could see in America for the first time. Obviously, it's been the case in Europe for some of the major European countries for some years now, but it's a policy tool that they could put into place.
Will, thank you very much. Just to recap your thoughts, this is the best environment that gold's could see.
Yeah, I think that this is a very positive environment for gold right now. I'm excited to be part of this gold market. And I think, like I said, the thing is, it's definitely not euphoric. It's early days, in my opinion. And I think it's just so quickly, or just happened so quickly after this crisis that we've been through, the worst of it being only in March, only a few months ago. So I think the effects of the policy, the stimulus has still got room to run. Clearly, the interest rates, we don't see any movement in that for some time. And with a presidential election coming up, we haven't even talked about in November. There's also the possibility for more volatility in the market, and therefore people looking for something that's not correlated to the stock market.
We'll save the political influences on gold for another conversation. Thank you very much for talking with us today and sharing your insights.
Thanks, Niels. Always a pleasure. Thank you.
Thank you very much for watching Kitco News. For the latest in the precious metals markets, go to kitco.com. Stay safe and stay healthy.